Hello and welcome to ET Market Smart Talk live stream. Well, I'm your host, Kshitij Anand, and today we are diving into fixed income, a space that's back in spotlight as a global interest rate cycle nears an inflection point. Well, joining me is Marzban Irani, who is CIO of Fixed Income at LIC Mutual Fund Asset Management Limited, who will help us decode where the best opportunities in bonds lie for 2025 and beyond. Thank you, Marzban, for taking the time to join us.
Thank you, Satish, for having me on the show.
Thank you so much for taking the time out. And let's start with the global backdrop. In fact, Jerome Powell Jackson Hole's speech always sets the tone for markets worldwide. What were your key takeaways, and more importantly, what should fixed income investors in India read into it then?
Yeah, so some signal from the Fed was awaited, and markets were happy. After the
Hmm.
unemployment data, the Fed has given a signal that probably going ahead there can be a cut, and the markets were really awaiting some kind of a signal. And the dot chart and the Fed fund implied probability was also showing, indicating there is a 50 basis point cut during this year, and when is that
Right.
cut going to come? So this statement really helped us. As far
Yeah.
as inflows are concerned, on an immediate basis, these inflows will be in the US because there is a rate cut expected. The rates are still higher, but
Okay.
as the parity comes in with the emerging markets, as the rates come down in US, then the money
Hmm.
will start flowing into the emerging markets over a period of time, and
Right.
that time emerging markets will get some flows.
Absolutely. So if you look at the inflation part of it, U.S. inflation is probably around all-time highs. You could say that plus 4%, but compared to Indian inflation, which is around about 2% and lower. So in this context, what's your outlook for the Indian interest rates over the next 6 to 12 months?
So, two, three things which have happened during this month. At the beginning, we saw a policy on the domestic front where
Hmm.
the rates were left unchanged because in the initial phase, the previous policy we had
Yeah,
aggressive rate
50 basis
cuts.
point. Yeah.
Yeah,
Hmm.
50 basis points. And then during the mid-month, around 12th, we saw the headline inflation coming in at
Hmm.
1.5%. That is again positive as far as if the on the domestic front we want to cut rates further. And
Sure.
in this week, in the last week, we are going ahead. We are going to have data on the growth, the GDP numbers, as well as the growth numbers in US. And in the next month, we'll have the Fed policy, where
Hmm.
probably we might see some cut kind of a thing. So all these things together are positive for the October policy. For the next 6 to 12 months, I would tell the investors stay put. There was some pain in between.
Yeah.
Let's take the benefit of that pain with all these things. I think when the inflation is at the bottom, at these levels, 1.5%, this is a good
Hmm.
time for the domestic front. Also, if there is a last cut pending, it can be given. Um,
Hmm.
I think they are taking some time because of the global tariffs and other things which have cropped up,
Hmm.
and
Okay.
that's why the currency movement is very volatile. And hence, over a period of time, once the Fed cuts, I think we'll get some comfort to go for some additional rate cuts going.
Absolutely. And within the fixed income space, there are multiple pockets of opportunities, be it government bonds, AAA corporate, even high yield credits. Where do you see the best relative value right now?
See, all three are different buckets as far as credit is concerned. I always tell investors more than credit. If you really want to take that risk, go and take it on the
Hmm.
equity front. I mean,
Okay.
it's not worth it because
Right.
of the illiquidity in the corporate bond markets in the lower
Sure.
credits. But
Hmm.
as far as government securities and corporate bonds are concerned, the PSU bonds in the 2 year, 3 year bucket are in a very sweet spot, and
Okay.
one can be in those type of schemes, the short term
Hmm.
category, the banking PSU category. So 2 3 years PSU bonds are a good in a very sweet spot. As far
Hmm.
as GSEC is concerned, at the very long end of the curve, see there are some investors who always say that I just want to invest for say 30
Hmm.
years or 25 years.
Exactly.
They can buy a
Hmm.
long-term GSEC and stay
Okay.
invested. The yields are
Hmm.
very attractive, 730, 735. So for that.
Absolutely. And in fact, we saw some bit of selling from FIs as well, although, they've been net sellers in the equity markets, but we're seeing some bit of selling in the debt market as well. So How do you expect the foreign inflows into India debt market to evolve post, and obviously, we saw a big development of inclusion of the India G-Sec in global bond indices as well.
We saw the JP Morgan index results. Now we are awaiting the Bloomberg index inclusion. Currently,
Okay.
what is happening in the US, as I mentioned, the rates are on the higher side at this point. So attracting flows becomes a little challenging. But as we go
Yeah.
ahead, and our rating has also, global rating has been upgraded,
Right.
all this will lead to a better percentage allocation to the
Hmm.
indexes. That will lead to more flows in the medium to long term.
Absolutely. And for let's say conservative investors, there's always this duration dilemma. Stay short and reinvest, or lock into longer maturities. What's your advice, and how should they approach this decision in the current interest rate environment?
So for conservative investors, I think they should be, even I would say aggressive investors should be in the short end of the curve. We are at the bottom of the rate cut cycle that has really peaked out. Sorry. As we go ahead, I don't see more rate cuts coming in, maybe one rate cut on the domestic front. It's not that we are going to see very deep rate cuts going ahead. So it's better to
Okay.
be at the short end of the curve, be in a money market category or be in a short term kind of a category, which is in the
Hmm.
2 year, 3 year type of segment, and just take the accrual for the time being. This is not a time to be adventurous. Last 2, 3 years, fixed income funds have done extremely well. July
Right.
22 was, I think, the peak. That time the yields peaked, and then they have been
Hmm.
declining only. And we have seen double-digit returns in a lot of categories on the fixed income
Okay.
side. But as we go ahead, that looks little challenging.
Absolutely. And with equity valuations looking stretched and volatility high, what role can fixed income funds play in asset allocations today?
See, equity is for growth and fixed income is for stability. This is what
Right.
I tell investors. So when there is volatility because of these wars, tariffs, these type of things on the
Hmm.
equity side,
Hmm.
asset allocation, in terms of fixed income will give you
Right.
stability. Even gold is giving stability to the portfolio of a lot of investors. And
Right.
if you notice, the multi-asset funds are in flavor,
Yeah.
because people want to diversify their risks across asset classes. Fixed
Right.
income, always gives a stability to the portfolio, and hence,
Uh-huh.
it should be a part of the individual portfolios.
Absolutely. And finally, if you had to leave our listeners with one key message for fixed income investing in the, let's say, remainder of the 2025, what would that be?
Don't expect those double digit returns. Don't look at the past returns of 2 3 years and get
Right.
into fixed income. Be happy with the stability that the fixed income is giving you.
Right.
Next 1 year is like a accrual kind of a year. And as we go ahead, as new inflation basket also is coming up, as we all know, there will be changes. The food component might be tweaked, and then we'll see how the CPI shapes up. So
Right.
and then our global rating is upgraded, more inclusions in foreign indexes. All this is bullish, positive for the fixed income markets. So don't expect too much of returns immediately. Stay put,
Uh,
stay invested.
Absolutely. Well, keep your expectations in check. That's a message coming in from Ajman. Well, thank you so much for sharing your valuable insights with our audience. And to all our listeners, thank you for tuning into ET Markets Smart Talk Live Stream. Thank you so much for your time, Ajman.
Thank you, Sitish.